students, in today's class we will be discussing about the accounting concepts. So in continuation to the above 4 points, we will today discuss the fifth point, which is about the dual aspect concept. The word dual refers to double. So there will be two aspects normally when every transaction is going to be entered. So this is called as a dual effect. For example, Mr. Arun starts business with cash rupees 5 lakhs. So here you can see that two actually transaction are taking place here, though it is only one. One is going to be a cash of rupees 5 lakhs, which is actually coming inside the business, and secondly there is also liability which is arising to the extent of same rupees 5 lakhs. So this will be the example for a double aspect or dual aspect concept. That means, so whenever a transaction is going to be performed, every debit, okay, will take an equal and corresponding credit, and similarly for every credit there will be an equal and corresponding debit and vice versa. So this will be normally the basis of a double entry system of bookkeeping. So here an accounting equation is to be followed by taking capital and the liabilities as a sum, and the equal to this will be the assets. Thus we put this as capital plus liabilities is equal to the assets. Next, let us move on to the periodicity concept. Whenever accounts are actually prepared or performed, it is done for a particular period. So usually the period when it is referred to as 365 days or 52 weeks in a year, or it could be 12 months in a year. So it is for a particular year. So this will enable various persons like the investors, creditors, employees and the government to know the performance of the business. And once the performance is known, it will be also enabling them to measure this performance. This measurement of performance will further help them to select a particular period, usually as I mentioned already 1 year. So by taking a year, now they can come to know what had been the performance of the business in that particular year. So hence we can say that financial statements are prepared after every accounting period. So usually at the maybe end of every year, a statement is actually prepared. We normally call as the income statement and the balance sheet. And it is to be noted that financial statements are prepared only at the end of the accounting period and not at the end of its life. So this is something very important. So thus, while doing so, it also furthermore helps the owners to know what will be their income or profit level, so that it could be distributed to the owner or owners. In case of company forms of organization, you will have actually many owners, okay, there will be joint owners. In that case, income doesn't go to one individual person, but it has to be actually distributed among many. So for this also this periodicity concept is actually helpful. And not only that, it also helps to compare and evaluate the performance that has been arrived at various periods. And then coming to the matching concept. So here we are going to actually take two important aspects. One will be the revenues and the next one will be the expenses. So what do we do with these two? Okay. As per the matching concept, revenues made or earned during an accounting period are matched with the expenses incurred during the period. That means in a particular year, okay, say for example during a span of 12 months, they will actually consider all the revenues that have been earned and the expenses incurred, and a matching takes place here. Okay, so by doing so, what do you mean by matching? Just arriving at a difference. So this difference is nothing but revenue. So thus we can say this matching concept is helping the business or the firm to earn revenue. And not only that, there are actually two concepts which will be applied here. One will be the accrual concept, and then next will be the periodicity concept. So we were discussing the previous periodicity concept just some time back. So which means that we try to actually measure the performance. So by measuring a performance during a particular year, say for example one accounting period, so it will help them to determine their performance during that time frame. And not only that, in also by preparation of balance sheet, the financial soundness or the financial status or position of the business can be ascertained. So thus we can say only expenses related to the accounting period, that means current year alone. So when we say accounting period, that means it refers to the current, that is present year alone will be considered. So about the accrual concept we will be discussing in our further classes. Also, adjustments such as outstanding and prepaid expenses along with the accrued and unearned revenues will be considered. Next, followed by creating provisions for depreciation of fixed assets is also done. So, what do you mean by depreciation? So, when fixed assets are used due to wear and tear, they will cause reduction in their values. And furthermore, if there are any bad debts on account of any debtors not paying any cash by committing a default, that also has to be created as a provision. And all this will also be helping in the sharing of profit or losses. So here it becomes very important that the revenues earned during an accounting period will be considered and it will be matched with the expenses incurred in the same accounting period. In all these aspects, matching concept will be helpful.